This evening, we're going to be talking about job cost estimating. Now, job cost estimating, I know you do this. I know that you have mentioned that you have done some of this stuff, and a lot of the people out there who are working in the trades end up doing this sort of thing. And it's one of those things you pick up as you go along because it's not formally taught in the programs nor in business school. The business students don't learn it either. So what we have to do is to be able to kind of find some system to be able to do job costing in a way that makes sure you make money and that the customer feels that they're getting value. And again, it goes right back to this marketing initiative. We want to charge a price that's high enough to cover our costs and give us a profit, but not so high to cause the customer to feel like they're being ripped off. He or her is being ripped off. We've seen in the marketing and sales, unit that putting a price on something like a product, like this computer here in front of me, or this speaker outfit, it's pretty, it's a step process that should be easily accomplished. First of all, we need to identify what the pricing constraints are. What's the minimum price we have to charge in order to cover our expenses? What's the maximum price we can charge so that we don't frighten away all our consumers? That gives us some sort of a constraint, what the bottom price is and the top price is. What is our basic objective? We're trying to sell lots. If we want to sell lots and lots and lots, we're making a little bit of money in each one. We make it up on volume, meaning that we can afford to charge it on the lower end of that spectrum. If we're going to sell a few and we really need to make money on the few we sell, we got to charge on the higher end of that spectrum. We got to be able to determine how many we're going to sell in the second step by saying what is the demand and what is the revenue. So that way we can determine, like, are we in the high volume or are we on a low volume item? And this cost volume relationship has to be figured out because there's fixed cost. And whenever we buy things, like if you're in the machining business, you have to buy a lathe. And that lathe is going to last you so long, you got to be able to pay off that lathe. So you got to build that into the price of your products. Then you got to select the price level, which is generally the price you're going to charge, with giving yourself some room for providing a discount to a customer because some reason or another, they're a good customer, they're a frequent customer, they're trading something in. Any number of reasons you may want to give some sort of price, but you still need to make money on it. And so these adjustments are really what you're keen on. So this process works really well and fairly easily done when you have a standard product. As I say, this particular piece of equipment is a standard product. You put a price on it, you're selling lots of them, way to go. But what if you got pricing that is not for standard products? So if someone comes in and asks you to do a job for them, how do you put a price on that? That's a little more challenging. These same things apply. You got to make enough money in order to cover off your expenses. You have to think about how many you're going to make. Usually it's a one-of. And you got to think about, what kind of adjustments potentially. So still some of them apply, but fundamentally, getting to the price is a little bit more difficult with a one-off or a specific thing. So we call this type of pricing on items that we're familiar with or items that are pretty easily tagged in terms of this is $9.99, for example. That's called standard pricing. And standard pricing is usually what we apply to standard products that go out the door of our retail shop day after day after day. A carton of milk, a bag of flour, a bag of chips. These are standard pricing. But standard pricing is not suitable for service products because how do when you're selling a service, you're selling nothings, right? You need to be able to sell something that's intangible. It's very hard to put a price tag on something that's intangible. Or when you're selling individual one-of items, such as a piece of work that you do for someone for machining. So you need to be able to come up with a method to be able to, first of all, develop an estimate. What is the approximate cost of building this product? And then you got to be able to go to the next stage, which is to be able to quote someone on it, meaning that you give them a relatively firm, you're giving them a firm price. There's no relative to it. You're estimating how much it's going to cost you to do. Then you got to say, okay, I got to make this much profit on it. You're going to have then to be able to give them a quote. So So they're just going to come to me and say, Paul, you're going to pay $994.34 for this. And then Paul has a decision to make. He either accepts it or rejects it based on that. So a quote is slightly different than an estimate. An estimate is for your purposes. A quote is for the purposes of the person who is buying it from you. In terms of getting to that, then how do we do that? Well, we need to be able to understand some of the tools of job cost estimating. So we need to determine the cost of the job, and the goal is really to get it as actual as possible. In other words, we know what our costs are. We can determine our costs after the fact. Well, can we determine them before the fact? And that way we can put a price on it. So the before the fact issue, then what do we need in order to come up with what our general costs are? So, let's think about our general costs. Well, what makes that up? Well, the materials. Obviously, if you're machining something, you need a piece of metal, and you go buy the piece of metal from a company, you know how much you're going to pay for it. Okay, so the materials that you buy, stainless steel, a piece of stainless steel is going to come in, it's going to cost you $349. You got to charge certainly more than $349 for it. Then you got to think of your labor, and you say, well, okay, how long is it going to take me to take that raw piece of stainless steel and convert it into a propeller, let's say? So you got to estimate your labor. Now, labor is usually calculated on a per hour basis. So if you think about, okay, I'm going to work and I want to make my labor rate is $100 an hour, let's say. It's going to take me 4 hours to do it. 4 times 100, $400. Okay. And that's going to be really the quintessential parts, the stuff that you put into it and the amount of time it takes to convert that stuff to something that's saleable. That's what you're really doing, is quoting on that. That is going to be the foundation for your price that you charge on something. That's what's called a quoted item. You also need to consider contingencies, because I know in my own situation, if I estimate that will take me 4 hours to do, and if I find that in reality it's taking me 6 hours to do, yet I set you a quote, if I sold it to you and I quoted you 4 hours work, I can't charge you 6. So I'm going to have to suck up those extra 2 hours. That's not a good way to do business. So you need to build in some contingencies. Sometimes things are not always as they seem, or it's more complicated than it looks, or you've had some problems with the equipment, or any number of things that could come into play. You have to pay people overtime. So contingencies need to be built in. That's a bit of overage that you're going to charge over and above what you would normally charge, just in case, to make sure you make profit. Then there's statutory fees and charges. An example of a statutory fee and charge is tax. You have to charge someone, if you're a retailer and you're selling, or a manufacturer, or a service provider, the government dictates that you need to charge tax on that item. Now, there's exceptions, but the fact is that you need to add on the tax. The HST has to get put onto it, and that's what's called a statutory fee. If you buy tires, for example, you have to charge a fee of $3 for an environmental charge. Electronics, there's a charge for that. So these are what are called statutory fees. We also have holding charges. Sometimes, for example, in order to save your place in line for this product, or in order to get it at a certain point in time, like I want it in 3 days, or if you want me to hold on to it for you for a period of time, I'm going to charge you a holding charge on that. And that just relies on the fact that your money as a manufacturer or as a producer is tied up in this product until I actually pay for it. So you're just charging me something to cover that. And then we got this fixed cost, which is really hard to determine. You buy a lathe that costs you $20,000. You figure that lathe is going to cost you 20 years. So every year, you're going to have to charge off $1,000 for sure, $1,000 on that lathe towards your products. If you're making 1,000 products, it means you need to charge $1 per product for the lathe in order to really compensate you for purchasing the lathe. So these are fixed costs, and these are costs that do not change regardless of how many you make. So you know you're going to have to charge off $1,000 a year for the lathe. If you make one product, or if you make 1,000 products, it's still going to be $1,000. So you're going to have to charge that $1,000 onto one product, $1,000 charge for your fixed cost. Or if you make 1,000 products, you're going to have to take $1 per in order to do that. And then finally, you have to build in your profit. You need to make profit, because why are you doing this unless you're making a profit, right? You got to eat. It's money that comes to you in reward for your talent and your time. So when someone walks into your shop and asks you, okay, I want you to quote me a price on this propeller or this item that I'm getting made, there are two things that you could potentially do. You can give that person what's called an estimate. And an estimate is strictly we think the cost to you will be. And the estimate is not something that the courts or that person will hold dear to them and say, that's going to be the cost of this guaranteed. Okay? So there's wiggle room in an estimate. And if you're unsure of something, and if you're not clear on how much time is going to take you to do this or what's going to be required in this, it's best just to offer an estimate. That means if, for example, you ran into problems, you can charge off that extra cost legitimately in your work. The quotation, on the other hand, if someone comes in and says, okay, I don't want an estimate, I want a quote. In other words, tell me exactly how much this is going to cost. A quote is really a guarantee. When you develop a quote, you are guaranteeing someone that you will charge them this amount of money and no more than that amount of money for a period of time, usually 30 days. You have a time limit on a quote, how long a quote's good for. Now, if you're in a period of rising prices or high inflation or high interest rates, you're losing money every time that someone comes in and says, okay, give me a quote on that. And then they come back to you in 100 days time and looking for that same product. If you give it to them for the same price, you're actually charging them a lower rate because the time value of money plays into it. Money loses value over time, and it loses a lot of value over time in the case of high interest rates or high inflation, meaning that the dollar can't buy as much today as it could buy last year. So you got to be very careful with quotes. So this idea of doing an estimate is relatively easy to do because you have wiggle room. The quote, you want to be really sure on your numbers before you give in someone a quote. So the estimate is the preferred route because it is really fast to prepare. It can be reasonably accurate depending on what you're quoting. Okay, depending on what you're estimating, I should say. And it got to be understandable to the person on the other side who you're handing it to. So it has to be written in such a way that they can figure out why you're charging that amount of money. And from a marketing point of view, it legitimizes it. If someone says, what? It's going to cost me $900. If you lay it out to them why it's costing them $900, it certainly makes a lot more sense to them. If your time, for example, takes 7 hours to machine something, the general person has no idea how long it's going to take to do that. So you need to be able to generate, first and foremost, an estimate, which is a ballpark figure. How do you get the ballpark figure? In order to issue estimates or quotes, you really need to consider your costs. Okay, your costs are the critical thing. You got, as I say, the variable costs. The variable costs are the things that change with the number of products you produce. So if I come into you and I want to say I want 2 propellers made, you're going to have to go get 2 pieces of stainless steel. So your cost just doubled with regards to the product, right? So if it's let's say it's a $300 piece of stainless steel, you're going to buy 2 of them. That's a $600 piece of stainless. 2 pieces at $600. So those are variable costs, and variable costs are relatively easy to track because you can tell I'm going to need this per unit. So you just add up all those thises, and voila, you have your variable costs. The one that's a little bit more challenging for you to calculate is your fixed costs, because fixed costs are ones that are sometimes they're called overhead costs. Okay, if you got a building that you have to heat, you have to insure it, you have to keep the lights on in it, you have to pay someone to clean it, you got to pay taxes on it. All of those things are fixed costs. In other words, if you produce 1 product or you produce 1,000 products, you're still going to pay those basic charges. If you have a machine shop that didn't do 1 job last year, it doesn't matter. The town is going to come looking at you for taxes. If you got a machine shop that has a lathe in it that's sitting there for a year, you're still going to have to pay for that lathe. So these are what are called fixed. So if we have a good estimate of our variable costs and we have a good estimate of our fixed costs and some way of reasonably doing it, as I say, you know, if you think a machine is going to last 20 years and it costs you $20,000, that's $1,000 a year. So your fixed cost would be that you'd have to spread over your products of $1,000. So variable costs, some of the things you want to consider are direct labor. You know, if you got a machinist on a machine, that's direct labor. That person needs to be stood up by that machine. That person is getting paid X dollars an hour. So right off the bat, it's going to cost you X number of dollars to do that product. If it takes 3 hours, 3 times whatever the rate is. The direct materials, these are the pieces of stainless steel that you're going to use. And some costs are what are called semi-variable, meaning they may change. You know, electricity, for example, is a good thing like that. If you're on a demand charge, normally businesses are on what's called demand charge. If the business goes over a certain amount of electricity they use in a given month, Newfoundland Power will charge them an extra amount. These are what are called variable, semi-variable costs, meaning that they're normally fixed in the sense that you know how much electricity you're using every month. You know, if you think about your house, you know how much. If you're on equal pay, you know how much. But, you know, it could be a situation where you use some more because you're doing a lot of work. And in terms of the fixed costs, your things like your rent, lease, administrative costs, you got to pay, you know, you got a secretary or you got someone there that's an administrator. They're not directly doing the jobs, but you need that person. That person has to get paid. So your staff, your supervisors, your managers, all that comes into the cost of running your business. That's a fixed cost. You can know what that is every year. You're going to have to pay out this amount of money. And we got this thing called depreciation. As I say, you know, that lathe of yours that cost $20,000, if it lasts you 20 years, effectively you got to take $1,000 a year. And this is effectively what depreciation is. It's just apportioning how much of that machine is worn out and how much value it decreases every year that you use it. And normally depreciation is calculated like that. It's what's called straight line depreciation, where you have a piece of equipment and you say, okay, it will last me 20 years, so every year I'll deduct 1/20th of it. Or there's other methods of it too, but the basic gist of it is that you're charging off some of that fixed cost. So in order to do the estimate, you need to really go through this series of steps. You need to say, okay, what is the job? And what are the various portions required to bring that job through to completion? So you have to visualize it in your mind. If someone comes in and says, okay, I want a propeller made, you know you got to buy some steel, you know you got to put it in the lathe, you know you got to machine it, you got to drill holes in it, you got to finish it somehow. So you're thinking about all the components that are required and how long it's going to take to do each of those components. You know, the materials would be the stainless steel, 2 pieces at $200 each or $300 each, whatever it is. That's what you need to consider. So listing the materials, estimating the cost of each of the materials, then the number of hours it's going to take you to change that piece of chunk of metal into a propeller. That could be, you know, a 4-hour venture, a 6-hour venture, a 10-hour venture. Your experience will really tell you how long. A lot of companies have what's called rate sheets that will say, okay, in order to do this type of machine work or this type of work, like on a car, how much time to change a set of tires, for example, that's all portioned out in terms of we allocate 1 hour to that or 2 hours to that. So, you know, last week we talked about the house plan. You know, you think about the time, planning the house, preparing the site, that sort of thing. You can calculate how long it's going to take to do that in terms of hours and the amount of time that you're going to pay someone to build something. And then you're going to, if you got some subcontractors coming in too, the costing subcontractor is relatively easy because you're going to go to the subcontractor. They're going to do all this work with regards to pricing. They're going to give you a price. So if they have to anodize a piece of metal, so you send that out, and they're going to charge you $200 to do that. Well, that gets built into your cost. So the subcontractor thing is pretty easy. And then you list all the items that you'll have to purchase. You're trying to get a handle on the fixed cost there. You know, the rent to get the job committee, the permits, the other issues, you know, in terms of like if you're building a house, porta potties, these sorts of things. You got to consider all of those other costs that come into play that will end up being fixed, really. And you need to build those into the cost for building these particular products that you're going to build, and your price is going to have to reflect that. The key thing is, if you're not someone who's astute at this, meaning you haven't done this lots, over time, experience will teach you how to do this well. If you don't have that luxury, you need to get a second party to double check you. So it's always good to go to someone and say, okay, here, I've worked out the costs for this, or projected costs, or project time, projected estimates. Does this seem reasonable? Have I missed anything? Is there anything that I need to do different? So these are really key to go through, you know, what's the job? What are the materials? What's the cost of those materials? How long is it going to take to turn those materials into what I need to make? If they're subcontractors, what are they going to cost? What are the other sub items, the support items? How much are they going to cost? We're going to cost each of them, and then we're going to get it double checked. So on the surface, it sounds really easy. If you make a mistake at this, in terms of you don't do it well, you can end up overcharging, which could result in loss of customers. Or worse, you could end up undercharging, and really the jobs are going to start costing you money, and that's not a good way to run your business. So what are some key advice items? Experience is critical in cost estimation. The more experience you get at it, the better. It's a great thing to have on your resume because all companies need to do cost estimation. In order to build on that experience, some things that you really need to do is to keep accurate records. So if you can refer back to your last job and say, what did I charge there? How did that work out? You know, if you got records, you can easily do that. Record all credit invoices. This is particularly important. For example, you have subcontractors. How much did this contractor cost me last time? You know, what are some of the things there in terms of products I had to buy? How much did it cost? Gives you a good head with regards to what are the other alternative costs are. And then finally, you're going to really say, okay, look, I estimated this project would cost me $800 to do. It actually cost me $900 to do. You got to learn from that mistake or learn from that and say, okay, next time I need to change what? And that's where the adjusting the estimates based on your actual experience comes in. So learn from each estimating experience. What can you do better, different next time in order to improve the process? So it is very much an iterative process. Here's a simple example of how to do this. Let's assume, for example, you have a gear come in, you see someone got teeth smashed out of this gear. Never happened to me, anything like this, but this is something that is fairly common in the industry. So you got someone walks in the door, they got a gearbox there off some piece of equipment. There's a bunch of gears inside it. And they say to you, could you fix this? So you look at it and you see that the teeth are gone on this gear here, and you say, okay, I can fix it. Okay, now how much is it cost to do that? That person asks. Well, let's think about it. The first thing you need to do to go through this first process, you know, if we look at the processes there, what needs to be done? What are the various portions of the job? So you got to tear down the gearbox. Someone got to take this apart. It's not going to look like that when it comes in, right? It's inside the gearbox. Someone has to take it apart. You got to clean all the parts. Then you got to get to this part here. You got to grind off this bad parts here. You got to weld pieces on. You got to weld some new teeth on it here. Then you got to put it in the machine and machine the teeth so that they're all tapered appropriately and the like. And then once you got it all done, you look at it and say, that's wonderful. Now I got to put it all back together. You got to add up the cost of each of these things here. What is it going to cost to go through all these steps? So you can do that And, if you know Excel, it is really helpful to have a good handle on how to do spreadsheets. Spreadsheets are not complicated to do, but it's always good to have some experience on this. So here, for example, is a sample of a spreadsheet. When you set it up in a program like Excel or Google Sheets or whatever, there's lots of spreadsheets out there. They all work exactly the same. In these pigeonholes, you just put in welding rods, steel, grease, seals, other. These are the things that you require based on your knowledge, what you feel you're going to require, which is really looking at this list of materials. Okay, that step there. So you're going to require some welding rods, some steel, some grease, some seals. Okay, you can't think of anything else. So welding rods, you look at that and you say, okay, there's 5 teeth gone. I'm going to need 5 welding rods. They're $10 each. That's $50 in total. So the spreadsheet will take this and multiply it to that. Steel, you got a piece of steel there. You know that you got to buy that. That's $30, from your supplier. Grease, from the supplier, that's $5. And some seals. You look at this piece of equipment that's brought in, no sense to put it back together without some seals. You go and you cost out the cost of seals. They're $25. So right off the bat, when you do this in terms of the materials, you know that the materials are going to cost you $110. Now, you need to build in a contingency here because you're thinking, I don't know, this is an estimate. So you have a standard rule in your estimating that you charge 10% of materials for other indirect costs. So basically, we take 10% of 110, that's $11. So the total material cost, to give you a good coverage to say that I'm satisfied, is going to be $121. So, okay, we've got the material costs straightened away here, and then we need to estimate and list all the hours. So let's go to our spreadsheet and look at the hours. Well, our labor, we need someone to weld it. Now, it's going to take, in order to weld on those 5 teeth, it's going to take about a half an hour of setup and an hour to do it. We charge out our welding at $25 an hour. So this is 1.5 hours at $25 an hour, comes to $37.50. The machining, again, half hour to set it up, an hour's worth of machining. That's charges at $30 an hour. So 30 times 1.5 is 45. Then the assembly and disassembly. I've put 2 of those together, but you got to take it apart and put it back together. So you got to set it up. And let's assume it's a half hour to put it together. So that's a total of an hour. Set it up just means get all the parts ordered up together. $25 an hour, 25. So we know that our total of labor based on our estimate then on this little spreadsheet will be about $107. Taken together then, the materials and the labor is $229. We want to consider our overhead fixed costs. Just going back here, we have to estimate, list all the hours, then we have to list each subcontractor. All the other items that we'll need to purchase, we need to consider that. So we do that in our little spreadsheet right here where we have what's called overhead, which is a standard of 30% of total materials and labor. So we take the total materials and labor, which is $228, and we just add 30% to it. So we know that, for our purposes of estimating, it's just shy of $300 to do this bit of work. We want a profit of 25%. That's standard. So we add our profit to it. And this comes to $371. So we estimate the cost to the person who brings that piece of equipment in looking for to get the gears fixed is going to be $371. You're not necessarily going to break it out in this great detail for the individual. They might not see, for example, this $25 profit margin or materials. It may not be broken out to this detail. This is for your purposes in terms of creating the estimate. So that generally you can safely assure that it's going to cost about $371 worth of work. You present that to them, they'll decide whether or not they want to proceed with this. Estimating takes time. So, if someone walks away, you give that to me and I say, nope, sorry, forget it. Well, you just spent an hour putting this together. And, again, you won't be too long in this business where you're wasting a lot of time doing estimates and people walking out the door for you to realize that, gee, this can be a time-consuming waste of money. So you need a system to make this happen. This is where I say spreadsheets are helpful, because you just plug in hours and it'll do all the calculation for you. It speeds up the process. You might also want to consider, is this price fair? Is this reasonable? Is it comparable to what other companies are doing in terms of your estimating? And, are your costs reasonable here? And more importantly, are they too low? Experience is going to adjust this. So that gives an estimate. An estimate is an approximate cost. And really what the person is going to get is something like this, which is not as detailed as this. So it's something like this. And what that will have is a sheet that is called an estimate. So this is East Repair, for example, and it's a bill to, ship to, the estimate number, the estimate date. So you put a date on it. Why do you put an estimate date on it? Because they could come back in 10 years' time and say, you told me that this was going to cost me $371 to do 10 years ago. Oh, you're supposed to honor that? So the date is very good for figuring out, now, is this estimate relevant? Because prices change over time, and obviously you need some policy. And so in this case, the estimate is good for 30 days. So here's an example, subtotal. So you give that to someone, they're going to stew on it. So what are the key ingredients of an estimate? The overall price is there, the breakdown of where that price comes from, schedule of when the work is going to be done, how it's going to be done, the terms and condition, payment is due in 15 days, good for 30 days, make checks payable too. Time period the estimate is good for 30 days, and the payment terms. So this is important because that's the basis on which someone's going to make a decision on whether or not to proceed with this. Now, that's the estimate. The quote is a lot more detailed in the sense that if you give a quote, someone's going to hold you to that price because it's a guarantee that the price will be there. So you got to go from an estimate is loosey-goosey. A quote is hard and fast. So you got to be very careful with quotes. So one of the things with quotes is that it's very hard to give a quote when someone comes in and are not sure what they want. So the very first thing you need to do before you ever ask for a quote is be clear on what the person wants and be clear to them that that is what you will provide. So you have to have clear requirements in terms of time, labor, materials, etc. Has to be clearly defined to you and clearly defined to the person so you know what you're agreeing on in the contract. Your costs have to be stable too. If, for example, we're into a period like we were with COVID where prices were rising, your wood, for example, doubled, and price of gasoline or the price of labor, anything like that, if you're going to give a quote and your prices could change from one day to the next, like the price of gas, you don't want that quote to be putting you in a position where you could be losing money. So the quotes are safe when the prices are stable, not so safe when prices are unstable. And you really want to be confident that the work won't turn out to be more complicated than expected. And that goes back to the first one, make sure the requirements are clear. So the quote, you'll notice, is almost identical in terms of its look to the estimate, but the quote tends to be a lot more detail in it. So here, for example, is a quote for some electronic equipment, okay? So again, we got the unit prices, what we call the extended price. So you're buying one at that much money, one times that much money is that much money. Now, if we're buying multiple units, it would just be that multiplied by whatever unit was. So here we have a quote for a piece of stereo equipment right down through, and the total of the quote is about $1,800. So what do we have in a quote? we got the overall price, $1,800, break down the components of the price. So, and again, that's useful for someone because they want to know exactly what they're getting. The period of quotation is valid for, and again, we've got some indication here how long it is, 30 days. A schedule for what work will be done. And again, that doesn't really work with this quote, but if you were in a machine shop, for example, you know, the product will be ready or the stuff will be ready within 2 weeks or that sort of thing. Full contract detail or full contact details of the business. And right here. And payment terms. So the payment terms, you know, as we've seen, 30 days, restocking fee, these sorts of things. So these are the things that will be on a quote. So there's very little difference in terms of the look between a quote and an estimate. However, the quote is hard and fast. The estimate is an approximate. Now, okay, so those are the two key things that we needed to look at tonight. The other issue is sometimes what government and large companies do is they look for quotes and they look for estimates. Well, normally they look for quotes. They're looking for higher prices because that's how a company is going to buy stuff. It could shop around, meaning it could go out and ask you how much. But an easy way from the company's point of view, a buyer's point of view, is to do what's called a tender. And a tender is just an invitation that is sent out to companies. It could be sent out broadly to say, please give us a quote on whatever, a new pickup truck or a job for work, machine work, that sort of thing. And government and large companies use tenders all the time because what a tender will do is lay out the specifications. Here are the exact things we need to do. So it forces specifications. And it also it would also ensure that the taxpayer, in the case of government, gets the best possible deal, meaning that you're going to ask for a tender. The tender is going to bring in a lot of quotes. You're going to pick the lowest quote that meets the specification of the tender. So it ensures that the taxpayer is getting the best value for the money. So how do you win a tender? Well, you got to win a tender by making sure you got everything right in terms of what's wanted and what's desired at the lowest possible price relative to all the other people who are bidding on the tender. So if you provide good service to businesses and government sector, you'll have to compete for contracts by submitting a tender. Although value for money can be an important component for many tenders, the way your price, your bid, but the way your price and your bid can also make a difference with regards to winning or losing the bid. So it could be more than just the price that is targeted on. Normally, for example, when we evaluate tenders, they're evaluated prices of, say, 25% is based on price, 25% is based on delivery time, 25% is reserved for, is it local, and 25% for quality or something like that. So there's some sort of a criteria in terms of evaluating the tender, may not necessarily be purely price. May not be purely price. So as with quotations, you're committed to the price you submit in the tender if it's accepted. So if you go send out a tender and you say, okay, I'm bidding on this and here's the amount that I'm going to charge, that's what you're going to get for it. So before you price a tender, check the instructions in the bid specification. That's very important. We've had in the town, for example, we're always doing tenders for products. And what's happening is companies are bidding on it, but they're not meeting the specifications of the tender. We look for a tractor that has a cab, for example. So this company bids, but the tractor doesn't have a cab. Well, it's disqualified right off the bat because it did specify that it is a cab. We got to compare apples with apples with apples. So for preparing a tender, it's very similar to preparing a quote. A tender is just a quote that's sent in and competitive bids. So you need a breakdown of the component costs as you do on a quote. Staff time and costs, you're going to figure out how much your costs are for this. Management time and costs, administrative time and costs, and estimates of reimbursable expenses. So if you're doing a contract or if you're going to provide a quote, you need to think about what are the costs of providing this product or service, and then what are some of the things that you got to build into the price, and are there aspects of it that are going to be reimbursed? For example, you bid on a bridge like the Shoal Harbor Causeway Bridge. You bid on that. Some of the costs may be reimbursable in the sense that you incur costs for keeping people in a hotel, and maybe the tender says that will be picked up by the town or whatever, that sort of thing. So there are certain costs that can be reimbursed. So the tendering process is normally used. In fact, you can go online, you can see lots of tenders. We also have another type of thing that's like a tender called a request for proposal. And a request for proposal is put out by the company that's buying or the organizations that's buying. The town, for example, would send out a request for proposals. And what that is usually for services as opposed to products. So request for proposals, again, is a competitive tender process that's designed to replace negotiation. So bidders are requested to submit their best prices and make them irrevocable. In other words, this is a quote that's good for 30 days, meaning you can't say, oh, sorry, that's off the table. Where tender documents are silent on the issue, any negotiation after closing will usually be characterized as bid shopping. This is a problem that a lot of companies run into. You bid on a tender, for example, and then you win the tender. So you bid on something, and then the organization that accepts your tender says, well, I want you to do a better deal on that. You're not allowed to do that. Once the tender is accepted, it's accepted. If there are other things that the company want you to do while you're doing the project, they got to pay extra for them. That's where you make money on tenders, is usually in changes that are taking place. So we can't change the bid change the nature of the tender after it's released, because it got to be canceled and restarted. Because again, that would be considered shopping tenders, where we get ideas from other companies and basically it doesn't create a fair playing field. So companies normally see what's called requests for proposals, but there's also other ones called requests for quotation, which is almost identical to a request for a proposal, or request for information. And a request for information is the simplest form. Request for quotation is the next simplest, and a request for proposals tend to be a much more complicated document where the buyer is ready to shop around and evaluate many factors and making a choice. There's specific detailed questions about the service, product, and vendor business. It's very formal, very direct, and provides a clear apple. You're comparing apples with apples. The provincial government in Newfoundland and Labrador has a tendering process. We've gone to that now. It's all electronic. You can go to the site, actually. This particular site right here, Government of Newfoundland, as the Public Procurement Act, it's called. Public Procurement Agency is the agency, but it's under the legislation called the Public Procurement Act. And all bids of the government are gone through there, of the provincial government. Same thing with the federal government. The federal government have a tendering online called buyandsell.gc.ca. And again, it allows for companies to bid on all kinds of interesting things. You can see, for example, here's the province. They put out bid opportunities here, and this is all provincial government organizations, including university, college, put these out. So let's say, for example, Eastern Regional Health Authority, they have bids there for supply of various things. Okay. So that's the province, and the federal government has a very similar setup for theirs. Towns generally don't have this. I don't know if the city of St. John's, towns usually go on some sort of request for proposals or tendering process, but a lot of this process now is electrified online, where you can go in and find out what bids are available.